/CH/N. Good evening, everyone. Friday's trading session was marked by a dramatic structural divergence across global markets. We saw China's ChiNext index plunge by 4.37%, with the Shanghai Composite retreating 1%. In stark contrast, the major U.S. indices, the Nasdaq, S&P 500, and Dow Jones, closed largely flat, at 26,281.61, 7,575.39, and 52,637.01 respectively. These are Friday's closing prices, as today, Saturday, is a non-trading day. Futures prices showed no significant movement. This clearly indicates a shift of capital away from China's tech and growth sectors, migrating towards defensive assets like U.S. Treasuries and cash, or specific safe havens such as Bitcoin, which saw a modest gain of 0.14%. The VIX Volatility Index remained at a low 15.03, suggesting U.S. equity investors are not yet in a state of panic. However, the sharp decline in A-shares, juxtaposed with the elevated 10-year U.S. Treasury yield at 4.57%, signals a repricing of global assets in the face of escalating tariffs and supply chain risks. Friday's trading character can be defined as a geopolitically driven structural sell-off, with the primary capital flow axis being an exit from A-shares and a wait-and-see approach in U.S. equities. Let's review the global market trajectory. In Asia, A-shares plummeted on Friday, with the ChiNext index down 4.37% and the Shenzhen Component Index down 2.29%. This was primarily triggered by China's temporary export ban on helium, effective July 10, and concerns that U.S. 301 tariffs would replace Section 122 later in July. Market fears over restrictions on tech supply chains, particularly for semiconductors and optical modules that rely on imported helium, rapidly deteriorated sentiment, leading to a capital flight from growth stocks. For Europe, while specific data is missing and confidence is lower, it's reasonable to infer that European equities likely opened lower and traded with volatility, impacted by U.S.-China trade tensions and China's export controls. The U.S. spot market was closed for the weekend, and futures pre-market quotes were flat, not extending the Asian panic. The low VIX suggests the U.S. market has not yet viewed China's helium ban as a systemic risk. However, adjustments to copper and aluminum tariffs under Section 232 could provide localized benefits to the industrial equipment sector. The emotional inflection point clearly occurred in Asia, with the A-share tech sector, led by the ChiNext, acting as a drag. The U.S. market currently appears immune, but we must be vigilant for any delayed reactions when it opens on Monday. Comparing this to our Friday morning briefing, which predicted volatile with a downward bias, the actual decline in A-shares significantly exceeded expectations, while U.S. equities remained flat. We correctly identified the pressure on A-shares but underestimated the impact of the helium ban. Our biggest blind spot was the sudden implementation of China's helium export ban on Friday. The geopolitical weighting was severely underestimated. Furthermore, the market largely ignored positive news, such as 23 U.S. state attorneys general opposing new tariffs on July 6, and the U.S. easing AI chip export controls to the UAE. Instead, capital concentrated on panic. A new structural signal is emerging. China is expanding export controls from rare earths and photovoltaics to helium. Supply chain security sectors, including critical minerals, specialty gases, and alternative equipment, could become the main theme next week. From an intermarket perspective, the dollar index DXY remained stable at 100.97, and USD/CNH traded at 6.7810. The onshore yuan CNH saw a slight appreciation to 6.7667, indicating the FX market did not overreact to the A-share slump. However, we should monitor whether the People's Bank of China intervenes. In equities, the sharp fall in A-shares contrasted with the flat performance of U.S. stocks. The 10-year U.S. Treasury yield, oscillating at an elevated 4.57%, exerted valuation pressure on A-share growth stocks. The bond market saw the 10-year U.S. Treasury yield rise by approximately 2% this week, reflecting market concerns that tariffs could fuel inflation. The interplay of a stable exchange rate, high U.S. Treasury yields, and declining A-shares highlights an inflation plus tariffs theme suppressing emerging markets, while U.S. equities maintain resilience due to capital flowing back into dollar assets. Looking ahead to the early part of next week, we have several verifiable predictions. First, the A-share Chi-Next index is expected to continue its decline on Monday, July 13th, with a 65% probability, potentially falling between 1% and 3%. The core driver is the inertia of panic from the helium ban. Second, S&P 500 futures are likely to open slightly lower, between 0.3% and 0.8%, with a 55% probability, driven by the transmission of Asian weakness and tariff uncertainties. Third, the DXY dollar index is expected to strengthen slightly early next week, testing the 101.5 resistance level, with a 60% probability. This is driven by global risk-off capital flowing back into the dollar. Fourth, critical materials sectors like tungsten and helium alternatives are likely to outperform the broader market, with a 55% probability, driven by catch-up logic and the supply chain theme. Finally, spot gold is expected to remain range-bound, with a 60% probability, trading between $40.80 and $41.30. Our current strategy leans towards observation, maintaining cash, and selectively engaging in tactical catch-up plays, such as light-long positions in Almonte Industries and Equipment Share. The confidence level for this strategy is 0.55, indicating a low conviction due to high uncertainty at the start of next week. In conclusion, geopolitical risks remain a dominant force, driving a cautious market sentiment in the short term. We anticipate a 45% probability of a market decline next week, a 30% probability of oscillation, and a 25% probability of an upturn. Investors should prioritize capital preservation and remain vigilant against potential downside.